right, let's get started this morning. Okay, let's give you an idea of what's going on. Wow, the S&P again. We got a problem because we just keep going sideways in this market. Now, here's the deal. Okay, we got the job numbers this morning, so I don't know what's going to do these stocks today. But if you look at the numbers, and we have 157 million workforce, or 49% of our U.S. population is working. We have almost 100 million, or 30% not working. We have 5 million part-time workers. Here's the big one. We have discouraged workers, 1.5 million. That's the number that kills, that makes all our numbers fake, the unemployment rate fake. So they use that 1.5 million to get us down to 3.9 unemployment rate. If you add that 1.5 million back in, we're back up to 12% unemployment rate. So the discouraged worker is just a bunch of nonsense, as we all know. It just, if you have a discouraged worker, they consider a person who has been out of work but been looking for work. If you've been looking for work in the last year, and you've been out of work for the last year but looking for work, they don't count you as unemployed because you're looking for work. Isn't that unbelievable? Anyways, so the BLS, okay, remember that agency, that's the same it's the government agency. They give us our numbers, and Moody's, remember, before we get it from the BLS, Moody's gives us a number. Moody's has about 400,000. They're a rating agency. You remember they're the ones that rated all they packaged with J.P. Morgan and Goldman Sachs and the rest of them packaged all their subprime mortgages that weren't performing, and they took those mortgages, sold them to pension funds. If you recall, Moody's, which is owned by Berkshire, helped them out by stamping all these terrible non-performing mortgages AAA rated when they weren't even performing, which of course was contributed largely to the crash. But we're supposed to be so lucky to believe them now when they give us an ADP number. So Moody's, right before we get our Friday number, give us an ADP National Employment Report. How they get that number is they have 400,000 business clients that do a survey. What, we're going to believe them? What are you, nuts? Last month, the ADP said they had 204,000 jobs, but then they were readjusted down 163,000. There was about 41,000 in fluff jobs. So BLS, okay, they're the ones we're going to be looking at their number today. They do a survey of 60,000 households or 110,000 people. They're no more truthful either. And they'll give us our morning number. We know that it's a fact that the BLS, they fudge whatever number they get, you got to deduct 40% right off the top, because it's the death birth metric system of assumptions. They just assume that corporations are starting and people are going to be hiring. Corporations are going to be hiring, just all assumptions. So you always got to deduct 40% off the top of that number. So bottom line, we have a 3.9% unemployment rate. We got to see if that's going to go up or down today. But the big number to look at is not the job numbers, the net job numbers, is wages. Its wages have been a real problem. This is why the economy can't grow. Because remember, you heard Steve Leisman the other day say, "Oh, the economy's booming, and people are spending more money than they're earning." And they've been doing that for 28 months. The last 28 months, spending much more than they take in wages. There is the problem. That's understandable, because wages adjusted for inflation since 1970 have increased on an annual rate, an anemic rate of 0.2%. That's it. Since 1970. For wages to grow on a sustained basis so that people can increase savings, and from savings is where you get investment. Okay? You got to have The workers need, their productivity must rise. And how does that? It's through CEOs taking their profits and investing it, plowing their profits back into capital investment, into new machinery and technology so they can produce more, and that's how their wages go up. Well, guess what? They're not doing that. The CEOs, between the tax savings and between their, they took their profits and they bought 800 billion in stock buybacks this first quarter. Last year was 500 billion. It's even more, 800 billion. So the point is, the problem we have and why we can't grow is because the CEOs refuse to take their profits, plow it back into their companies so that productivity goes up, so wages go up, so people can invest. Anybody on wages, if they're just scraping by, they don't have money to invest. And unfortunately, that's the majority of our working people. So the working folks aren't getting any wage increases. So they're not taking that money and investing it. Most of them aren't even contributing to their 401k. So what's been going on is it's the CEOs. They've been taking all that money instead of putting it into capital investment through stock buybacks, which their salary is tied to that stock buyback. And so every time they do stock buybacks and the stock price goes up, their wages go up. Their wages are up now 333% more than their workers. And then also the CEOs give to the big bondholders their dividends. So the big problem we are not growing the economy. And that's why the S&P, you see the S&P stuck here. Okay, that's why we've been stuck. We're not growing. We can't. January was the peak, and the stock market started to crash, and we're still in a crash because it's impossible to grow when all the growth. Okay, there's no growth in the economy. The growth is in the stock market, but only in a small sector. Because in the very wealthy, the CEO, who are taking their profits and doing stock buybacks, the workforce who's on minimum wages and have no extra money, they're not investing. So this thing can't get any better. It's the only way that they can move this market up now, okay, is through QE. That's it. So, and now if you go look at the stocks this morning, I was watching, I was up at 4 o'clock this morning, I went through the stock, watch this. Industrial stocks, XLI. They look just like the S&P. Watch. Everything stopped. See here the S&P. Now watch XLI. Industrials. They look like the S&P. They're not going anywhere. Matter of fact, they're getting weak. So if I look at my industrials, they're weak. So if I go and I look at CMI, look how weak CMI is. Industrial. Matter of fact, CMI, I'm going to place that as a short today. GE. Look at that. That broke down. That's going to be a short. Eaton. See, these are all breaking down. United Technology. So you look, it all looks like the S&P. XLI is one of the best sectors. XLB is our materials, same thing. And if you take the individual stock, FMC, PPG, they're all the same. Now you go down and take a look at oil, USO. Oil's starting to break down now. So now we got oil breaking down. So even your stocks, RIG, that were doing great, SU, they're all breaking down. Now you go to retail, XRT, they're breaking down. Look at this. They started to break down yesterday, along with cyclicals. Walmart, look at this, can't get out of its own way. Kruger, Gap. Yeah, you have a couple of winners like Lowe, but now they're selling off. Ralph Lauren, now they're selling off. But mostly overall, XRT is weak too. There's nothing in here. Why? Because you can't grow the economy. So the only way they're holding these stocks up is through stock buybacks. Now you go to dividend stocks, which I got 3, my favorite, my Budweiser. Okay, I'm going to watch that. Hopefully, usually Budweiser starts moving up over springtime. MO and AMC. But look at all week. So if you get my point, now you go down to discretionary stocks. Yesterday we saw them fall. KMB. Now why is discretionaries falling? Look how KMB fell yesterday. along with what was the big one that fell yesterday? KMB. There's another one that fell yesterday. We were in it. We got out of it. Clorox, but we only had a 2.7% loss. Why are they falling? Because the dollar's too high. Okay, they enjoy a weak dollar, and so, but they all collapsed yesterday. Starbucks, look at Starbucks falling apart. Yum, Visa. So no matter where you go, okay, the only thing. So if you think about the major sectors I just gave you, there's the major sectors of the stock market. So they're all collapsing, yet the stock market is up here. So you can see what's going on. So we got the plunger team holding the market up, and we got the stock buybacks, okay, preventing the crash from continuing down. And here you see it. So right now we got between stock buybacks holding up the market, and you got the government, or the Feds doing stock buybacks. So that's what's happening here. But when you go down to each sector, they're not being held up, they're going down. So that's the problem. So you can't have XLI going down while you got the market holding up here. You can't have USO coming down while they're holding the market up. You see what the point is? So that's why this morning we're going to let's see what the job numbers do, okay? And then we'll talk after we get the job numbers, and then we'll see. Right now, everything looks like a short. There's really very few stocks that right now have good long positions on them. We have a couple of power stocks, okay, and that's about it. We have PBF, but even they're pulling back this morning. PBF, HFC. So again, I think I'm right when I said the stock market started to crash on January 26th. And the only thing that's holding the market up right now, as I said, stock buybacks and the Federal Reserve doing the plunger team. And so Trump's got to make a decision. He's got to lower those interest rates by printing money and doing QE, or he's got to let the market just let it go and let it correct itself. So we'll see. Either way, we'll make money. Okay, I will see you on the charts.